Okay. Okay. Good evening, and let me welcome you to this CMA Sri Lanka webinar on value-based management in government. So we have our familiar face, you can see on the screen, Gary Cookins, CPIM, Analytics-Based Performance Management LLC from Cary, North Carolina, USA. So he is a fellow member of the Certified Management Accountants of Sri Lanka. We were honored to give him the fellowship. So a warm welcome, Gary, to you. We also have our council members, our Vice President, Mr. Hennak Bandara. Then we also have a number of our council members who are here. You can see Mr. Jayasekara is there, then many others. Also, I have invited a special panel who will be there to ask questions from you, headed by Mr. Hennak Bandara. We have Mr. Jayasekara, JMUB Jayasekara, is the chairman of the Public Sector Committee. Then Professor Dayananda Ambalangodage, he is a professor in Public Sector Accounting at the University of Sri Jayawardhanapura. And I think I've invited one or two others. I can't see them here. Yeah, then of course, we have our other council members, Mr. Gajendra, Ruchira Pereira, and others. So welcome to everyone, our members, and also our members from government and from the private sector. So this webinar is really one of great importance to all of us. It is really on, we are doing this series of performance-based strategic management accounting. This is series number 7. So the 7th webinar, we are very happy that our expert Gary Cookins has been conducting this, and I think it's maybe a record-breaking event for you. And doing it online is really a great feature that has enabled everyone to get this knowledge. As you know, government sector is a very, very important area, and currently we are all looking at the government budget. I was just going through some of the figures, Gary. It's a 4 trillion expenditure that they have provided, and of course now they have to see how the income can be generated to bridge to meet this expenditure, but definitely there is going to be a big gap. So considering this, although there was a reduction of about 500, I think it's about 500 million from the previous budget, we have to see how this value-based management in government, where we are going to spend 4 trillion Sri Lankan rupees, is going to give value to the citizens of Sri Lanka. In one headline, I saw that personal heavy ministries get boost in recurrent expenditure. So that means those who are having more people, more staff will get more recurrent expenditure. So most of the salary, the budget is going for that. And of course, capital expenditure has been also cut down by about 20%, and allocations. So the health ministry has gone up, but unfortunately, education, there is a dip of 4%, which may not be the best thing to do. So today's seminar, as I said, is on the government sector, and there are some very, very important things. I just want to read that. There is a growing impatience by taxpayers, citizens, and governance boards with waste and inefficiency that is leading to demands for evidence of outputs, outcomes, transparency, and accountability. Terms like doing more with less and value for money are prevalent and aimed at governments at all levels. I know there are different levels in the US, like the federal, the counties, cities, municipalities, but in Sri Lanka, of course, we have the villages, we have the municipal councils, and maybe various other smaller units. So pressures on government around the world are forcing them to adopt performance management, a focus on accountability for outputs and outcomes rather than price for higher inputs. So that's what we are saying. we are not going to ask for higher inputs, but we need higher outputs and outcomes so that the people will benefit. So I think that would suffice, because I'm sure our keynote speaker, Gary Cookings, who is an expert on this area, will now be able to take over. And I invite Gary now to commence his address on value-based management in government. Over to you, Gary.
Okay. Well, thank you, Lakshman. And also thank you to the ICMA Sri Lanka for appointing me as a fellowship member. I'm very proud of that. It's a privilege to present for you. You're right, this is my 7th presentation. I do want to manage some people's expectations. If you have attended some of my prior 6 webinars, there will be redundancy. I'm still going to be going through some of the basics, but it'll be okay. It'll be reinforcement. Also, if there's not enough time to answer questions, you have my email address there, so you're welcome to directly send me an email. So
they can also send any questions they have on Q&A, so that if we have the time, then we can maybe answer.
Yeah. All right. So many of you know of me, but those who do not, real brief, my bio, my undergraduate degree was from Cornell University in Industrial Engineering and Operations Research in 1971. I received my MBA at Northwestern University's Kellogg School of Management in 1974. If you're doing the math, I am 72 years old, but I feel like I'm 42 years old. My career was really in 3/3. My first decade was in industry, large manufacturing conglomerate in the US, FMC Corporation. Then many years as a consultant, starting with Deloitte, 7 years there, 5 years with KPMG, 5 years with EDS, it's now part of HP. And then up to 8 years ago, I was 16 years with SAS. And many of you do not recognize SAS, but it's actually the world's largest privately owned software vendor, 15,000 employees, specializes in analytics. Why are the books there? I think careers have a lot to do with luck and circumstances rather than being smart or competent. I had a couple of lucky breaks. When I was 27 years old, young, I was a division controller at FMC, but I had the chance to become the operations manager. And I discovered that rather than eating the accounting data I had previously served as the controller, I now had to basically eat it. I found much of that information to be at best useless and at worst dysfunctional and misleading. And that was a real wake-up call to me about the difference between external financial statutory reporting and internal management accounting. The latter is far more important. That's where you create value. Why are the books there? Second lucky break, 1988, KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. Many of you will recognize his name from the balanced scorecard work, which I will talk about soon in this webinar. But he did the pioneering work in activity-based costing. I got recruited to KPMG. I learned from Dr. Kaplan, implemented ABC for 5 years. I wrote a book that led to more books. You don't need to buy the books. If you go to Amazon or Wiley, chapter 1 is a free download. It'll give you a good overview. So let's get going. Who will benefit from this presentation? Managers who have previously struggled at promoting financial planning and analysis, enterprise performance management, and integrating business analytics into their decision support systems. Managers who intend to champion any or all EPM and business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is just because it's my observation that although it's nice to have senior executive leadership sponsor new initiatives and innovation, often they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down on the organization chart who have passion and ask themselves, how long do I want my organization to continue to perpetuate using stale and arcane methods? And they're the ones that'll do a pilot or a proof of concept or a rapid prototype workshop to demonstrate to their colleagues and executives above them, this is the way to go. So if you're 3 levels down on the org chart, that's fine. I like presenting to you. I like to start my presentations with 3 questions. What, so what, then what? So imagine your organizations implement several of the methods I will be describing in the next 45 minutes. I say celebrate for one day. You are not done. You and your organization will see so much more information that they've never seen before. It will beg the question, what's relevant? Which leads to the so what? But arguably the third question is the most important one, because all decisions only happen in the future, the then what? And we'll talk a bit about the predictive view, forecasting, budgeting, and the like. So my agenda, I'm first going to clarify the confusion and lack of consensus. What is this enterprise performance management? It's also called corporate performance management for commercial companies. Then I'll briefly talk about business analytics. Then I'm going to talk about 8 pressures that have caused interest in this, because many of the methods I'm going to describe have been around for decades, some even before computers. So why is there interest in this topic? And then I'll conclude with how it's a value multiplier. I always like to start with this cartoon: drowning in data, but starving for information. You have this poor beleaguered clerk, shoulders hunched, sad, paper all around him. And the supervisor in the doorway to the left is asking him, looks like you've got all the data. What's the holdup? You know, I gave you the request this morning. How come you don't have the answer this afternoon? And the message here is there's a difference between data and information. Data tends to be transactional. You convert the data into information to gain insights and make decisions. Now, much of this presentation is going to be based on a book I recently co-authored called Value-Based Management in Government. There's the link to it. The book has a foreword by David Walker, former US Comptroller. And I want to share with you that my co-author, Doug Webster, is actually attending this webinar. So Doug, I know you're there. When we get to the discussion at the end, I hope Lakshman will also allow you to make a few comments. Doug was the Chief Financial Officer for the Department of Education and the Department of Labor in the United States. You know, so he basically was reporting to the President of the United States, a very, very high level position. Doug previously also was a consultant with Grant Thornton, a wonderful background. Doug, I don't have your email address, but maybe when you come on, you can provide them. And others, if you want to communicate with Doug, look him up in LinkedIn and invite him, tell him you are at this webinar.
Gary,
So,
I will get him on to our panel. Okay, I'll transfer him. Okay.
Thank you, Lakshman. Looking forward to hear from you, Doug. Now I'm going to repeat the slide, the words that Lakshman said at the beginning. There is a growing impatience by taxpayers and governance board with waste and inefficiency, and it is leading to demands for evidence of outputs, outcomes, transparency, and accountability. Hence, in public sector, we hear these words, these phrases: more with less, value for money, quality of life. But there is pain in government. You have all the money to do anything. You just do not have the money to do everything, you know. So this means government agencies and not-for-profits. We'll talk about not-for-profits in this presentation. When I refer to citizens for government, those of you that are not-for-profits, think of it as members of your not-for-profit organization. You know, so you need to better prioritize and embrace productivity, effectiveness, and efficiency. But many are not ready for fiscal squeezes. They will come, and there is still time to react now. However, the longer one waits, the bigger will be the pain. So here's my key assumption about this entire presentation. We all underestimate that there are far more similarities than differences between public sector and nonprofits and with private commercial sector organizations. Public sector organizations and government and nonprofits continue to increasingly adopt business-like practices despite dwindling claims that we are different. And I want to share with you an anecdote. I was once presenting at a conference with people in the room, and a man stood up and he said, well, I'm leaving, I'm from government, and government's not a business, so your lecture's not for me. And I slammed my hand on the table and I said to him, I disagree with you, sir. I grant you 2 things. You cannot select your customers, and your goal is not to make a profit. What else is different between your government agency or nonprofit and a commercial organization? You all have limited resources. You have to use them in the most effective and efficient way to get value. So there are these similarities. So there is a convergence in government nonprofits with the managerial methods that I'll be describing in the next, 40 minutes. So let's talk about enterprise performance management. There is confusion and lack of consensus about what it is. Is it human resources performance management? If you do a web search like Google on just the 2 words performance management, the majority of the hits are going to be about the human resources and personnel function, employee appraisals. The problem is authors like myself and Doug Webster, we neglected to put the E, the enterprise adjective in front of it. Is it about scorecards, dashboards, key performance indicators and measures, as well as aligning the managers and employees with the strategy or the policy of the executive team? Yes, but that is a subset. Is it process productivity, quality improvement? Yes, but that's also a subset. Those terms are really about business process management, often called BPM. So that's sort of the domain of lean management, Six Sigma quality improvement, or is it all of the above and even more? It is. And the good news is this: enterprise performance management is not really some new thing that managers like you listening to me have to learn, but it's the integration of many methods that many of you are already familiar with. You've read it about in magazines and business journals and the like. The problem is when organizations do implement these many methods, like gears in a machine, they implement them in isolation. So you've got policy people in one part of the building. You've got KPI measure people in another part of the building. You've got risk management people in another part of the building. And by the way, Doug Webster's expertise is risk management, which I'm not going to talk about enterprise risk management, but Doug may chime in later. So the issue here is when you have all these people isolated in these different parts of the building, what EPM does is it seamlessly integrates them, again, like gears in a machine. Notice what I'm doing with my fingers. So you will get these slides PDF. There's the definition: analytics, performance management, integration, multiple methods. Oh, and you get more power, not only when you integrate them, but when you embed analytics of all flavors into them, such as segmentation, correlation, clustering, regression, especially predictive analytics. And the purpose is really to achieve the policy and strategy of the executives, make better decisions. So briefly, what is business analytics? Well, there's confusion there. Is it a data warehouse? Is it data mining with query and reporting? Like drilling down to a line item of a purchase order invoice to see an anomaly. Is it business intelligence with enhancements? And in a minute, I'm going to describe the difference between business intelligence and business analytics. Business analytics is a stage above business intelligence. Is it the technology of data governance, data management, data quality? And that's really the job of the IT director. And is it the probability and statistics like regression and correlation analysis and forecasting and optimization? And I know many of you listening to me took those courses in the university. You just wanted a passing grade and get out of there. Well, sorry, it's here, data science. But the good news is you don't need to go get your textbook out, but you do need skill sets in your organization that have these skills of data science and analytics. So is it all the above and even more? And it is. Rather than give you a definition of analytics, I could go to Wikipedia. Just think about it this way: work backwards with the end in mind. Regardless how analytics should be defined, there should be no argument as the purpose of it: better decisions and better actions. The analytics goal should be to gain insights and foresight and solve problems to make better and quicker decisions with more accurate and fact-based data, and to take actions. So I sort of lied to you. I said I wouldn't give you a definition. That paragraph at the bottom is pretty good definition. Okay, unifying EPM and business analytics. What business intelligence reporting does is it consumes stored information. What business analytics does is it produces new information from the stored information and what the BI creates. And what enterprise performance management methods does, they will deploy these analytics in each kind. And unfortunately, with 1 hour, I won't be able to give you examples, but each of the various methods, and I'm going to describe 5 or 6 of them, will deploy analytics, insights and actions. Queries simply answer questions. business analytics creates questions. Further, analytics then stimulate more questions, more complex questions, and more interesting questions. And most importantly, business analytics also has the power to answer the questions. And I'm going to get a little serious here, although some of you may be saying, Gary, you sound like you're really serious. Well, I'm a pretty funny guy, but this is serious. I think in the past, the best leaders and executives had the best answers. Today, I do not think that's the case. Today, I think the best leaders and best executives have the best questions. There's too much complexity. There's too much volatility. There's too much uncertainty for them to rely on their gut feel, or intuition, or the types of answers they had earlier in their career that got them promoted to the top. They need to create a culture for investigation and discovery and tolerance for making mistakes, as long as you learn from your mistakes. So I want to contrast business intelligence with business analytics. Business intelligence is descriptive. You react to it. It starts with standard reports, ad hoc reports. There's that number 3, that query drill down, OLAP. OLAP is an acronym for online analytical processing. It may be alerts, upper bound, lower bound thresholds. But what business intelligence does is it takes it to a higher level. So you can be proactive. Starts with all that statistical analysis, forecasting, predictive modeling. And then number 8, I call this Mount Everest, top, highest mountain in the world, optimization. So let's talk now about why the interest in enterprise performance management. I'm going to take 3 minutes to go through these 8 items, and then the rest of the presentation, I'm going to drill down into a few of them. We'll start with the first one, executive frustration with strategy failure or policy failure. For government, think of policy, strategy, they're kind of the same thing. The issue is here, most executives are pretty good at formulating strategy, formulating policy. Their big frustration is their organization not implementing or aligning with the policy. Number 2, and that's where we'll talk about the strategy map and balance scorecard from Dr. Kaplan and Dr. David Norton. We'll briefly talk about it. Number 2, increased accountability. Today, there is no place to hide. Managers and employees will be monitored. They will be measured. It doesn't necessarily mean their job security is at risk, but it could adversely impact their salary increases or job promotions. Number 3, more rapid decision-making. Unlike a few years ago when you could test and learn and have meetings in conference rooms, today people will be on the telephone, go or no go, yes or no. They have to make decisions in real time. They almost wish the executive was sitting next to them for the phone call so you could ask them, what decision should I make? Number 4, mistrust of the managerial accounting system for transparency and accuracy. Most managers do not trust the management accounting system. We'll talk about that later. They know that the accountants, the CFO, when it comes to calculating cost, especially indirect expenses, commonly called overhead, they spread it like peanut butter using some sort of factor that's got no cause and effect relationship. I'll talk about activity-based costing when we get there. Number 5, poor customer, citizen, member value management. The reality is citizens are really, and members are really the primary source of, if you will, that you want to create value to satisfy stakeholders like your management team. Therefore, we really need to measure how much does it really cost to serve citizens and members. Not very many CFOs or accounting departments are doing this. Number 6, contentious budgeting, poor resource capacity planning. This may surprise all of you, but I believe the annual budget process is so broken and is such a disaster. My recommendation is stop budgeting. So did I catch your attention? Probably. But that begs the question, what was the purpose of a budget in the first place? And how can we replicate it using some of the EPM methods? 7, dysfunctional supply chain management. This may not apply to many of you, because your agency may be directly interacting with your end users. But if you are in a supply chain with trading partners upstream and downstream, the issue here is most basically customers of a trading partner treat them like the enemy. oh, let's just pound on them, negotiate lower prices from them. If we put them out of business, so what? We can always get another supplier. That's got to stop. It needs to be a marriage. Supply chains compete with other supply chains. And finally, number 8, unfulfilled return on investment promises from large IT systems like enterprise resource planning systems, such as from SAP or Oracle or Infor. And the issue here is, if you ask the chief information officer, the IT director, 3 years after your organization implemented an ERP system like SAP, and you ask them, how well do you believe the return on investment from implementing that system met or exceeded the ROI that the salesperson sold you on 3 years ago? Many IT directors will be hard pressed to say yes. They'll say, golly, we just put 3 years into implementing this. We got a lot of data, but I'm not sure we got the ROI. What enterprise performance management does is it will release the ROI like seeds from the ground. So the ROI actually comes from the EPM systems, not the transactions. So for the next maybe 30 minutes, I'm going to drill into these 3 of the 8 forces. So let's start with the strategy policy failure. Failure by executives to execute their well-formulated strategy or policy. So this is a quick primer on the Kaplan and Norton strategy map and balance scorecard. You can see the 2 of them are in the ellipses at the bottom. And notice the strategy map arrow goes from the map into the balance scorecard. Many organizations allegedly claim they have a balanced scorecard. If you ask them, do you have a strategy map? They say no. I say, the strategy map is 10 times more important than your balanced scorecard. Your scorecard is just a feedback mechanism. The intelligence is in the map, and I will give you an example in the next slide, so be patient. But above that is arguably something more important. It's the vision and mission statement. That must come from the executives where they set the policies. Their goal is really to basically answer, or to set direction. Their goal is to answer the question, where do we want to go? But what the strategy map, balance scorecard, and all of the EPM methods I'm about to describe in the next 30 minutes, they answer a different question. How will we get there? What are the projects? What are the initiatives? Which core processes do we need to improve? So the strategy map and the balance scorecard, they're mechanical. They're like one of those gears in the machine. They help realize the vision and mission. Very briefly, typically this is a primer on Kaplan and Norton strategy map. For commercial companies, what they realized was executives were overreacting to financial results reported at the end of the fiscal period. They said, you need to shift your attention to non-financial metrics reported during the period and basically take actions based on what you're seeing. And they created these 4 perspectives that have cause and effect relationships from bottom to top. So the bottom one, learning and growth and innovation, that's really for employees. And then incidentally, the rectangles, each of those is a strategic objective. I'll give you an example in the next slide. So if they're accomplishing the perspective at the bottom, it will contribute to internal process improvement objectives. And if they're accomplishing those, they'll contribute to the customer retention and loyalty objectives. So if they're basically doing those, they'll contribute to the financial perspectives. So here is a fictitious example of a commercial company's strategy map, typically 2 to 3 to 4 strategic objectives. The arrows are called key performance indicators. They're measures. You get what you measure. If you can't measure it, you can't manage it. If you can't manage it, you can't improve it. So this is how we basically hold managers and employee teams accountable by defining the KPIs and then putting targets on them so that they have to try to achieve the targets. So aligning. So now some of you are saying, well, Gary, this sounds like it's a commercial talk. Well, I know it's government. So here's why I say there's convergence. A public sector and a not-for-profit, you basically can still use the same mechanism. The difference is you swap the first, top, and second perspectives. Now you basically, financial stewardship is the third one, and the top is maximizing community value, not shareholder value. That's a financial thing. citizens, patients, taxpayers, warfighters, members. This is an example of a strategy map from a Treasury Department in Europe. I'm not going to go through it. When you receive the PDF, you can kind of examine it and see, oh, that's how we would apply the Kaplan and Norton strategy map to a government agency or a not-for-profit. But to summarize, for government, a learning environment will stimulate process excellence. That will lead to the financial governance of your agency or your not-for-profit company, and that will create the value for your citizens, for government, or for your members, for not-for-profits. To simplify, the purpose of the strategy map and scorecard is, imagine if every employee in your organization, every single day, could answer this one question: how am I doing on what is important? How am I doing on what is important? Well, the first half of the question can actually be easily answered. The employee comes in the morning, turns on their computer screen, they see 2, 3 dials of the KPIs. They can see, are we favorable or unfavorable to the target set by the executives? The problem is the second half of the question, on what is important. How do you define what are the relevant KPIs? Strategy map and scorecards provide this answer. The overriding purpose of a strategy map and balanced scorecard system is to make mission, strategy, policy everyone's job. And I don't have time to answer how do you define KPIs, but if you go to my website, you can see it at the bottom left, Gary Koken's. There are free downloadable articles in the tabs. One of them is about defining KPIs. But there is a problem here. There's a lesson being learned by many organizations: KPIs or OPIs. So what do I mean by OPIs? Operating performance indicators. The issue here is when you ask companies, oh, you've got a balanced scorecard in? That's great. How many KPIs do you have? They say 300. That's tremendous. How can they all be a K? You can't have 300 key performance indicators. So the issue here is there are typically 2 to 3 KPIs per strategic objective. You cascade them down to get to operational PIs. KPIs, their definition is monitoring the progress towards accomplishing the strategy or implementing the policy. OPIs are more deep. They're all measures. They're all important. They just serve different purposes. The OPIs are then like measuring a process. Incidentally, if you're interested in a technique to implement a strategy map very quickly, and if you are for a CPA firm or a consulting firm listening to this, feel free to communicate with me. I can train you how to do what I'm about to describe. It's based on managers learn through doing. And it's basically based on a one-day workshop using the technique strengths, weaknesses, opportunities, and threats. You've probably heard of SWOT, the acronym. And it relies on using yellow Post-its. So you see these 3 photos? I'm just going to take 1 minute to describe how the workshop works. See at the bottom left, I have the managers and executives each fill out 20 yellow Post-its the night before the workshop. They come in the morning. I say, I've got the 4 perspectives now left to right. I say, put your yellow Post-it on the wall under which of the 4 perspectives. Next, in the middle, I say, for the next 30 minutes, look at the other yellow Post-its from your colleagues and move those stickies to ones that are similar. And look at what you see in the middle. 30 minutes later, there are 2 to 3 strategic objectives in each of the 4 perspectives. That's the white sheets of paper. We're done. 30 minutes later, we've already got the strategic. Now look at the picture to the right. There's the management team in the room. For the next 3 hours, for each objective, we ask them, what would be a project or initiative that will accomplish the strategic objective? And what's one example or 2 of a KPI? So see, you can do it in a day and be done. It doesn't take 3 weeks or 6 weeks or months. Let's move on. Number 4 of the 8 forces: mistrust of the managerial accounting system and its flawed cost allocations, misleading cost reporting, outputs, products, standard service lines, channels, customers, citizens, members, and outcomes. And the issue here is that the accountants basically are a little lazy. It's convenient to allocate certain expenses based on broad brushed averages, not using cause and effect relationships. And this is where activity-based costing came into play. So this is a simple way to understand ABC. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say to everybody, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Gee, you bought this low price salad, they bought the expensive item, they want you to subsidize them by splitting it equally. Well, that's how products and service lines in any organization, their costs also feel unfair when the accountants take this large amount of expense, typically indirect expense, often called overhead, and they allocate it like spreading butter across bread using number allocation factors like number of services provided, number of employees in cost center, volume, square feet, square meters. None of those allocation factor denominators reflect the unique consumption that the outputs, the citizens, the customers consumed of the end-to-end processes and the work activities that belong to them, that in turn draw on the expenses, the salary and purchases. So if you were to decompose all of the cost centers and put activities into them, and then reassign the activity costs to those outputs, you will discover, compared to that traditional standard costing, in reality, some of the outputs were overcosted and the others must be undercosted because it's a zero-sum error game. And yes, it will satisfy the external auditors like PwC or EY or Deloitte when they come in to audit the books, but it's wrong in the parts for the internal managers to basically get insights and make decisions. Now, the problem actually begins with this traditional responsibility cost center statement. Salary, equipment, travel. The problem is when managers receive this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And the answer is not much. I say that when managers receive this kind of report, they are either happy or sad, but they are rarely any smarter. And it's not that the report's a bad report, it's a good report. It's just the data. Notice data in this report is not structured in a way that can answer it. So what activity-based costing does, note in the middle box, key scan claims, analyze claims, but it's the same amount of money, the same $914,500. It restates the structure into a different structure, the language of work. Notice I'm using the back office of an insurance company. It's a factory too. And for you in government agencies, whether you're water purification or you're a tax authority, you still have similar types of activities for your organization. And once the activities are costed out, you then reassign them to the services, to the citizens, to the members, just like the waiter or waitress in the restaurant, using cause and effect relationships. Now I've rotated that first diagram 90 degrees to the left. It's not as simple as, oh, we just take our ledger expenses, we trace them into work activity costs, and then we reassign them into cost objects. It's more complex because the right side diagram shows you've got support departments that support other support departments that ultimately support the frontline departments that interact with citizens or deliver services. So it needs to be a multiple stage cost assignment network. Now, I'm going to warn you, the next slide is going to be very complex. I can only briefly talk about it, but if you do go to the Institute of Management Accountants website, imanet.org, I've been a 30-year member of the IMA, and I was actually the executive in residence. Do a search on my name, you'll find a statement of management accounting called Implementing ABC. It's 30 pages. It will take you through all of this in more detail. So here it is. It's not as intimidating as you may think. It has the three universal components of any organization's expense and cost structure. You've got the resource expenses at the top, salary, materials, phone, all that. You've got the work activities in the middle, and then they are reassigned and pile up at the bottom into the services or products, customers, and citizens. All of those arrows, think of them as thin straws or wide pipes where the diameter reflects the amount of money that's flowing through. That's why this basically is a reassignment network. Business sustaining or organization sustaining, bottom right, it's a special category. There will be some expenses that have nothing to do with serving members or serving citizens or delivering services, typically about 10% of an organization. So you basically create a final cost object like senior executives or board of directors, okay? They're causing some of that work. The basic message to this slide is costing is modeling. It's not T accounts and journal entries. The direct cost, not broken. It's a straight shot. You may have data integrity issues with that. That can be solved. Now, there are two different views of costs. ABC, I've simplified it, is basically about assigning and tracing costs to outputs, diverse ones. So all the X's in the middle, see, that's the table there. Those are activities. And then we reassign them to suppliers, products, customers. But we can also sequence, string the activities like pearls in a woman's necklace, end to end, to get the process view. So you can also say, well, what is the cost of this process? Because the lean management, the Six Sigma, the quality people are seeking process costs. They don't really care about output costs. And once you basically can do that, you can put them into what the lean management community calls value stream maps. So now here is the end-to-end activity strung like pearls. Some people call these swim lanes, and the height of the stack is how much it costs. And then they will tag value added or non-value added. So they can basically focus on where may there be opportunities to reduce cost, cycle time reduction, improve quality, and the like. So my message, advice to anybody wanting to do this is start with the vertical view, calculate what costs are of outputs. I know I have profit margins at the bottom there, but even to public sector government, they want to know, well, what is the cost per gallon of our water treatment? What is the cost per mowing the lawn of the acre of our community parks? What is the cost of processing a tax statement for a high income person versus a low income person? What? They want to know the cost of outputs. That gets a lot of people's attention. Once you've done that, now circle back and now go horizontally, focus on managing the process, removing waste, raising productivity. Some of you may be saying, Gary, you're starting to convince me that maybe our organization should do activity-based costing, but it'd be a mudslide of data. It'd have 3,000 work activities. Every employee would have to fill out a timesheet every day, and they hate timesheets. On and on and on. IT would have to extract all the driver data from. Those are all misconceptions. Unfortunately, they were thought the way to go 5, 10, 15 years ago. So when people did attempt to put in ABC, it was too big, too complex, unsustainable. So they say it doesn't work. There is a technique that I came up with. And if you're a consultant, you want to know how to do this for your clients. It's called rapid prototyping with iterative remodeling. Model 0 to the left, 2-day workshop, bring in 5, 6 cross-functional employees from your organization, build a very fast, high-level model. Doesn't have to be accurate, just basically is an examination of what your organization would look like. Bring in your management team and work colleagues the next day, show it to them. Very engaging because it's your own organization. The light bulbs goes on with everybody. Oh, that's how we can better trace and cost. That's how we can better understand what things cost. That's how we could do benchmarking with apples and apples, not apples and Oreos. Oh, they get it. It's accelerated learning. You do a couple of iterations for a week or two, you get to the right permanent, repeatable production ABC system, 3 weeks, not 6 months or a year. The message here, make your mistakes early and often, not later when the system is too hard to change. Why does rapid prototyping work? It has to do with this graph. I'm actually going to bring in the line. The vertical axis is the accuracy of what you want to know. Let's say, what is the cost per gallon of the water treatment? What is the cost to basically do an acre of cutting lawns? The horizontal axis is the level of administrative effort to calculate the data, validate it, report it. Notice you get an asymptotic curve, meaning the accuracy of the cost goes up very quickly, levels off, you get diminishing returns on extra accuracy for the extra level of effort of work. Well, since this is management accounting, stop at 95%. Good enough. It doesn't have to be that complex. Typical ABC models don't have 500 work activities. They have maybe 50, 60, 70. What rapid prototyping accomplishes, it's accelerated learning. Everybody understands it in a day. It solves that thorny leveling problem. Gee, how many activities will we have? 500? No, it will right size itself. It prevents over designing the model so it's so big, too complex, not sustainable. And also then peer groups. You can ask the managers in that second day, when this model, it becomes a system in 3 weeks, what types of decisions will you use it for? So we actually we're committing them to use the information. Going back to Doug Webster in my book, to summarize what is ABC for government organizations. ABC transforms inputs, meaning budgets, into outputs and outcomes. ABC answers fundamental questions such as, what do things cost and why? We know why, because we have drivers. It further answers who in particular receives them and how much cost did they each receive. Example of output costs are the cost per each type of process tax statement, or the cost per each type of rubbish disposal when the garbage truck goes to different stores. Let's quickly go to the budget. I mentioned the budget is broken. It's typically a fiscal exercise done by the accountants that has 2 problems. It's disconnected from the executive team strategy and policy. It's not based on future driver volumes. This will be funny. How many of these apply to your organization? Our annual budgeting exercise is invasive and time-consuming with few benefits. It takes 14 months from beginning to end. Well, maybe 6 months. You start in June for the fiscal end December. It requires 2 or more executive tweaks at the end. So when you give the executives the first draft of the budget, they say, well, that's too much spending, go make some changes. Next, it's obsolete in a couple of months due to events and reorganizations. You publish it in January, by March, everything has changed, so the budget's not really relevant anymore. Next, it starves the departments with truly valid needs. Maybe in the next fiscal year, you've got some new services that's going to require you to increase the number of employees in a certain department, but you don't give them enough, so they're understaffed. Next, it caves into the loudest voice and political muscle to people like me with gray hair, those veterans, the ones that have been in your organization 20, 30 years. They know how to sandbag that budget. They know how to put padding in there. Next, it incorporates last year's inefficiencies into this year's budget, meaning the process was inefficient this past year, and we're replicating it and continuing it, still inefficient this next year. But this last one is the one that bothers me the most. When a manager is 3-4 months on a glide path from the end of the fiscal year, and it becomes apparent to them that they're not going to be able to spend all of the budget that was approved and allotted to them for that year, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that their next year's budget is going to be pegged, incremented from how much they spent this year. We call it use it or lose it spending. And see if you relate to what I'm going to describe verbally. How do you do your budgeting in your organization? You give every manager a spreadsheet January to December, and you ask them to fill that out for every line item in their expense account, including rubber bands and paper clips. Someone in the accounting department then consolidates all of them. You give it to the executives. They look at it, they say, that's too much spending, go make some changes. So you give the spreadsheets back in Excel, people lower some of the spending, back to the accounting department, consolidate it, back to the executives. They say, it's better, but not good enough. Up, down, up, down, up, down, up, down, up, down. Come on. You almost want the executives to tell you what number did you want in the first place. That would save us a lot of time. But that would be the executive's aspiration. We want to know reality. So we don't want to do this spreadsheet budgeting. We want to basically do it using a modeling technique. So very briefly, here's how to basically do performance-based spending. Every organization will be the end of two types of river streams. The upper river stream coming at you is the repeatable recurring expenses. It's demand driven. The bottom river stream is non-repeatable, non-project related work, okay? So let's drill down into how we basically calculate those numbers. For the routine operational expenses that are repeatable, we always start with the expenses, the resource, the process and activity costs. Remember, we calculate them in the past. But for the predictive view, we calculate the system backwards. I'll show you what I mean by that with this description. For the historical view, last month, last quarter, the spending is known, you calculate the cost objects, but you get a bonus. You pick up the unit level cost consumption rates. And with those consumption rates, then for the predictive view, you forecast backwards. You forecast the volume index, how many students are going to be in the school, how much gallons are going to be required by our water filtration plant, how much garbage trucks and rubbish is going to have to be picked up. See, I'm giving examples of in government sector. And then we do something which I think I learned my second semester, freshman year in industrial engineering at Cornell. The forecast of the demand, volume, and mix times the unit level cost consumption rate equals the capacity required, the number and type of employees and their wages and salaries and purchases with suppliers. I always, Glaxman, you've heard me say this many times. I'm an engineer masquerading as an accountant, even though I've been an accountant since age 27. You need to think like an engineer. So let's go back to our two river streams. For the upper river stream, what you do is you calibrate the unit level cost consumption rates, and those costs are very good for other decisions. We calculate backwards based on the forecast. For the non-recurring, very briefly, if you remember the strategy map, we go there for each of those strategic objectives. We fund how much money would be needed to implement the project. We also have risk management, which Doug Webster may be able to talk about. For the risk management community, they use something, it's a method of looking at the mitigation expenses of the more likely risks that may occur. So we want to spend money on mitigation. And then we've got capital projects, which everybody's familiar with. So get ready. I'm going to decompose this diagram. You'll be able to get it though in the handouts. Start at the bottom right. See derived budget and rolling financial forecast. The shaded boxes in the upper right, that's the repetitive work. So we bring in the unit level consumption rates, we forecast the volume and mix. See, what that gives us is the capacity resource plan, number of labor hours, pounds, kilograms, number of employees, and so forth. That's our operational budget. From the left, notice 2, 3, and 4. 2 is capital budget. You're all familiar with that. 3, strategy budget. We get that from the strategy map balance scorecard. And number 4, risk budget. We get that from enterprise risk management professionals who basically know how to basically determine how much money is required to mitigate risk. We bring it all together. It's a good number. It should, but again, when we give it to the executives, they may say too much spending. So we need to go revise something. The temptation might be, well, go back and postpone or eliminate some of the strategy budget expense, postpone or eliminate some of the risk mitigation. That's bad. We do that, then we expose ourselves to risk. The only lever in this diagram that you can really do is consumption rates, productivity, 2%, 3%, 4%, 5% productivity improvement in the future. That's where the lean management and Six Sigma people come into play. So let me start concluding here. This is a diagram I created that shows how do all these moving parts, how does it all fit together? Now in my computer, I have some diagrams of performance, Deloitte, from KPMG, but they're all IT diagrams that would be recognizable by the director of information services. But I want you to understand fits together. So before I'll take you through it in a second, more so, but your organization resources is the big purple box. That's where your employees and your assets are. The way this diagram is, think of it as a circulatory system, like your heart with your blood going through. And notice what I've got is I just put in an arrow that says we want to go from the citizens, or for the not-for-profits, your members, and connect them to stakeholders. That's the whole idea. Citizens are the starting point, and the stakeholders, meaning your management team, we want to satisfy the citizens. Okay, where is analytics and management accounting in the diagram? I don't have it. Why? Because the output of management accounting and analytics is the input into so many different places. It's pervasive. All right, let me go slowly. How does this diagram work? We start with the strategy, the policy, and mission. I should put policy there for the executives. They will define that based on the changing needs of the citizens of your agency or your members if you're a not-for-profit. Once they have that, they will communicate their policy, strategy, mission to the managers and employees using strategy map, balanced scorecard. Risk management will be part of that. Risk management has what's called KRIs, key risk indicators. They're like precursors to KPIs. If a KRI is going in the bad direction, soon after the KPI is going to go in a bad direction. So that gives us the balanced scorecard and dashboard. Once we have that, remember, every morning, each employee can turn on their computer screen. They get feedback. They can answer that question, how am I doing on what's important? But when every employee gets that feedback, then you can answer, how are we doing as an organization on what's important? So those three red arrows to the left, that's strategy management, policy management. Now we've got targeting. How much does it cost to satisfy different types of citizens? We've got people in the US, different zip codes. In your agencies, people who live in different parts of the county or part of your country. We've got different age groups, senior citizens, young people. We've got schools. There's so much diversity and variation in your citizens, but you want to at least start with, what does it cost for each of them? Because once we know what it costs, we can start asking so much better questions. What can we do to either better serve some or basically not overserve others? Then we come to the process improvement. Basically accept the citizen or the member's request for service, deliver it. See that circular? This is the better, faster, cheaper. This is the world of the SAP, the Informs, the Oracle ERP software. This is the world of lean management, Six Sigma, the process improvement people. And if we're doing all of this well, then really stakeholder wealth creation is not really the goal. It's a result. So I hope your computer screen can see what I'm showing. These bubbles are flowing through every minute, hour, day, week, month, year. Think of them as veins. But if any of these veins is restricted or confined, then the money that you spent doesn't go to the stakeholders, it leaks into the sewer. So this is why we need to have better productivity. So we really, if you optimize our spending. To conclude, what's really happening is there's a shift in the return on investment from tangible assets to intangible assets. So what I mean by that is there's a shift of the return on investment for any organization's purchasing, from buying things like trucks or machines or computer hardware to information. And you'll see in this slide that the return on investment from information increases exponentially as we go left to right, from data to information to knowledge to insights to decisions. The problem is many organizations, probably many of you that are listening to me, you're restricted and stuck to only the first two red bubbles. All your employees and managers have is raw data and standard reports. All that you can answer is what happened. In some cases, in the third bubble, your IT director will give some of your managers what we call business intelligence reports, drill down. Example of vendors are Click, Tableau, Microsoft Power BI, SAS, my previous employer. But even that ability to drill down and look at an outlier or an anomaly, you're still restricted to only answering what happened. Enterprise performance management begins with the first blue bubble. It's modeling, it's descriptive modeling. The strategy map is a model on a single page. Costing, as I mentioned, is modeling. It's not T accounts and journals. You're modeling how expenses are consumed by outputs. So we not only can answer what happened, why did it happen? Then when we go to the predictive modeling view, this is the future view, rolling financial forecast, driver-based budgets. We can not only answer what happened, why did it happen, what can happen. We can look at options. We can do what if scenarios. We can do sensitivity analysis. And then we get to, again, Mount Everest at the top, prescriptive analytics optimization. It can answer not only those questions, what happened, why did it happen, what can happen, what's the best choice that can happen. So let me conclude, Laxman. I'll be done in 3 minutes and then we can have the discussion. This is my big frustration. Why has the adoption rate for analytics-based EPM methods been so slow? Well, there are 3 barriers that are causing it. The first one are technical barriers, and they include IT-related issues, such as dirty data, low quality data, but the IT department has some tools. One's called extraction, transform, and load, ETL. They can purify the data. You also, if you're a larger company, you may have different hardware vendors, IBM, Dell, Hewlett-Packard. IT can fix that. The next barrier is this perception it's too complex, it's not affordable, it'd be not worth the effort. And I demonstrated to you in this presentation, there are techniques. You can build a strategy map balance scorecard in 1 day. You can build an ABC system in 3 weeks, not 6 months or a year. But the real problem, the big barriers, got nothing to do with software or technology or methods. It's all organizational behavior. It involves resistance to change, culture, and leadership. What do I mean that? Let's start with resistance to change. People like the status quo. People don't like change. Only babies like change with their diapers. Other issues, fear of knowing the truth or fear of other departments knowing the truth. Oh, I don't want other departments to know what it costs for me to do the garbage truck disposal, to do the water at the cleansing factory. Or fear of knowing the truth, or fear of being measured, fear of being held accountable. Weak leadership. There, I even said it. Not every executive team's got the highest IQ. So my point here is the real barrier to implement these methods is really requires change management skills. None of you have degrees in sociology or psychology, maybe a few, but you're going to have to learn how to have change management skills to get buy-in. So next to last slide, action step, get educated. Thank you very much. You're doing that by listening to this. The rapid prototyping pilots, start small, think big. Pay attention to incentives. You got to motivate people. And there's a couple of links there to some articles. So the complete vision of performance management. Notice I've got these spinning titanium, gears. That's what you want. You want faster revolutions per minute, better, faster, cheaper. That's the process improvement. Safer, incorporating enterprise risk management, smarter, strategy map and balance scorecard. Your success depends on how well, how fast the right information gets to the right people. So I know, Laxman, I went 5 minutes past the top of the hour, but let's quickly go into discussion.
Thank you, Gary. I think we are very, very thankful to you. Maybe you can come out of the share screen so that we can get the others also on. Yeah, fine, Gary. So thank you very much. I think that was very, very useful. In fact, this is not only for government, but also for non-profit institutions. So you know that CMA, we are also a non-profit organization, and I'm sure we have all our council members here and our senior staff listening. So I'm sure it will give them a very good lesson. as to how we can improve our efficiency, our productivity, reduce the wastages, and very many things you mentioned. But now you have your co-author, Douglas Webster. I think before we go into the Q&A, because our panelists are waiting to ask many questions from you, can I invite Douglas Webster to say a few words, because we are very honored by your presence today. I must thank Gary for inviting him. So can I invite Doug, to say a few words?
Well, thank you very much for the opportunity, and thank you to Gary for inviting me. I will start off by saying I've known Gary for, I don't know, maybe 35 years. I first met him because I worked on a doctoral dissertation in activity-based costing many years ago. And so a lot of the ABC kind of background I had. That having been said, and even though I've co-authored a book with Gary, I learned an awful lot here just sitting here this morning. And I'll just say quickly, and then I'll turn it back to you, that value-based management is a little bit of a different topic that we didn't get to in depth, but it is very, very much related to everything that was said here today, because at the end of the day, every one of us want to deliver value to our stakeholders. And this is one of the, when I say one of the means of the ends, I don't mean it's an alternative. It's a critical element towards that delivery. Cost, performance, and risk need to be integrated into a value proposition. And what we've heard today is part of that. So thank you.
Thank you, Doug, for those very, very encouraging comments. But I think we would like to hear more on the value creation, because that's something that, as I mentioned earlier, we are just having a budget that is coming on the 12th of November, but a lot of expenditure is going into the budget, and we like to see what is the value that is being created. So thank you very much, and I'm sure you can also answer some of the questions that are coming. So what I would initially, the first question is someone who is really very much involved in the government side, public sector management. We have Professor Dayananda Ambalangodage from the University of Sri Jayawardena. So Dayananda, may I ask, because I think you are having a few questions, maybe to both you can ask questions.
Thank you very much, sir. It's an excellent presentation, and it's also comprehensive, and it really, talk much more about how value-based management really can be achieved. But I have two questions. One, I think finally, Gary very clearly highlighted three reasons: technical reasons, perception issues, and behavioral issues. Based on that conclusion, I would like to raise two questions. One is, don't you think that political, social, cultural factors as well really, barriers for implementing, or achieving value-based management, especially in government sector? That is the first question. And also, second question is, based on your, past experience, how can you really, what kind of strategies you are proposing countries like us to overcome those issues and barriers?
Okay, I don't have a degree in behavioral change management, but I can just tell you my observation is how to get buy-in, which is really what the issue is. How do I get people to buy in to make these changes? Involves asking questions. We call it the Socratic method, like the Greek Socrates, but asking pain questions like, hey, do we know what things cost? Do we know which of our citizens we're over-serving or under-serving? Are we measuring the right things? See those three types of questions. Now, it could be career limiting. When you ask this of your executives, they'll say, why are you asking me to fire that guy? But what you're doing is you're creating discomfort. And the starting point for change is discomfort. Because once you have enough discomfort, they will say, well, how would I answer that? How would I know what the right things to measure? How would I know? And then you can educate them and say, well, here are these enterprise performance management methods. So it's really it's a sociologist or psychologist tool or technique.
Thank you,
What
Gary.
else?
I don't know, Doug, you have any comments on that?
No, I
Yeah,
think
go
that
ahead.
was well stated, and I'll just leave it with Gary's comments.
Okay, fine. Sorry, Gary, I think you were going to say the second question. Yeah.
Next question.
Okay, next one. Can I ask Mr. Hennaik now? He's been heading one of the largest savings bank in Sri Lanka. So I'm sure he has some good questions that he can field to Gary.
Thank you, Professor. Gary, I would like to ask a question in the context of public sector in Sri Lanka. As Professor Bhatwala mentioned that I have been involved with the public sector bank in Sri Lanka. If I may tell you the statistic, in 2020, Sri Lanka state sector working and retired employees alone took home 86% of the total tax revenue. The criticism of the taxpayers and other stakeholders is that the value addition of the public sector is totally inadequate. So my question is, how do we measure the value created by the public sector employees to avoid such criticism?
Boy, I think I'm going to swing that over to Doug. Sometimes you can do surveys, in commercial worlds, they do customer satisfaction. So I'm not sure, the issue is, how do you quantify something that may be subjective? But Doug, how might you answer that question?
It's a good question, and I appreciate your response, Gary. Measuring value can be particularly challenging in the public sector for the obvious reasons. And as Gary noted, surveys and so on with your stakeholders, discussions, etc. I think when I talk about value, as I believe I briefly mentioned before, it's the interactive balancing of three things. What I call results, resources, and risks. What am I going to do for you? And when I say, what am I going to do for you? I mean, we collectively for our stakeholders. So, it's that. What are we going to deliver? What resources do we have to make that delivery? Because we all have to balance costs and benefits. And what are the risks that we find acceptable to take on in that balance? That's a three-way interaction. You cannot do that well for your constituents in the public sector unless you understand those stakeholders. So that's partly the government agencies that fund you. It's the beneficiaries who take advantage of your services. It's all of that. And that, of course, requires this interactive discussion and back and forth and trade-offs. So that, unfortunately, there's not a simple answer for that. But I think anyone in the public sector inherently understands that challenge.
Thank you. Thank you, Doug. May I now post the next one to Mr. Jayasekara. He's really involved in the professional education and also the school education. It's all on the private sector side. But let me ask him, because he's also chairman of a public sector committee, to pose any questions to you.
Yeah.
Over to you, Mr. Jayasekara.
Gary, thank you very much for an excellent presentation. At the beginning, you told that you were at 72, but to me, you were at the other way, 27. So that you are very, very young. So now, value-based management in government, there are 4 areas to be covered: planning, performance, cost management, and risk management, PPCR. How can we apply this into local government management? Because, in Sri Lanka, we have provincial councils and other local councils, municipalities. So these type of organization, how can we apply these 4 areas to get high value to the general public?
Oftentimes I'm asked, how many employees, how large does a company have to be to use these enterprise performance management? And my answer immediately is 25 employees, 25. They always think it has to be hundreds and thousands, because for costing, if you've got diversity and variation in your types of members or outputs or services, it's going to create indirect expense overhead. You want to trace that properly. You still want to have alignment of the employees with the policy or strategy executive. I could go through all the examples. So my point is, size is not an issue, even very small. You know, I didn't talk about some of my government experiences. I actually helped implement activity-based costing for the IMF, the International Monetary Fund. I did it for King County. King County in the United States is the 8th largest county. It's the city of Seattle. And all of their various agencies, we put it in. Some of their agencies only had 50 or 100 employees, but there were like 20 agencies, and that gave them the information on the cost. I very much like your 4 items, the way you described it, but I guess I'm really not answering your question. I'm kind of saying, I don't think those obstacles should be getting in the way. It has to do with leadership. If leadership wants to use progressive methods, that's the way they should go. Here's the problem, though. We don't always have great leaders. I have a saying, leaders without followers are just taking a walk in the park. We need leaders who basically have people follow them. Other questions?
Thank you.
On the risk, Doug, you can mention, I think it was not covered, Doug, because Gary said that you are maybe expert on the risk area, what was mentioned by Mr. Jayasekara.
Yeah, my passion, or one of my passions when we talk about risk, is specifically enterprise risk management. And too often those terms are confused or thought of as synonymous. In my mind, they're very, very much distinct. Risk management, I think we all know, is the management of uncertainty. But typically, traditionally, that's done within very narrow stovepipes and different programs and functions and so on. Enterprise risk management is about stepping back from that and taking a portfolio view of risk across the entire organization, and recognizing that you may need to sub-optimize in one area to be able to bring resources over to another area, for example, that benefits the larger organization as a whole. So it's that portfolio view that ultimately we want to take as an agency, and not sub-optimize agency interests for the sake of constituent elements. What I just said about risk management and how that concept is incorporated in enterprise risk management also applies to what we've been talking about today, I believe. And that is, we need to be thinking about how we balance results, resources, and risk from a portfolio perspective across the entire agency. Value-based management, in my mind, if you want to really simplify it, it's not a whole lot more than risk-based return on investment. Everybody understands return on investment. You adjust that for risk. That's simple. But what is much more complex, or it's not that complex if you really start thinking about it, is how do I step back that from on an individual decision to taking a more collective approach across the agency, willing to sub-optimize in some areas for the benefit of the overall. And as what Gary was talking about today is an element of that, but so is risk. And one last quick question, because I don't want to take up much time here, but I believe this concept of EBM will help bring to the discussion people who are focused on cost, or who are focused on performance, or who are focused on risk, so that they understand that each of those elements contribute to a much broader and more important conversation.
Thank you.
Mr. Jayasekara, you have another question, or can I pass on to others? Or?
You can pass it on to the others.
Yeah. Any of the other Rujira, you have any question?
Professor, can you hear me?
Yeah, we can hear you.
Gary, I have a question to you. Now, in your balance scorecard, in the strategy map especially, you have mentioned how the strategy is cascaded from top to bottom. Now, my question is, now if investments are not coming in, if in the government sector, if there is lack of investments, will it affect the top line objectives?
Can you repeat that question? I'm not sure I understood what you're asking.
In the strategy map that you have shown Of course, now there are 4 perspectives in the balance scorecard, and of course, we know that there should be investments to drive the strategy. So if the investments are not there in the government sector, will it affect the end objectives?
I'm not sure I'm understanding, but let me just make an observation. The Kaplan and Norton strategy map, you don't have to be totally aligned with it. There are some organizations actually add a 5th perspective, like chemical companies will add safety and health. So I think the key is to just understand the concept of what Kaplan and Norton came up with was you've got this sort of a connection from bottom to top and things contribute. I think you were asking about investment.
R&D. I'm asking about R&D. If the investments in research and development.
Oh, research and development. There's a question I've always asked is, can you afford your strategy? And remember, for the government, it's strategy and policy. Policy, strategy are kind of like the same thing, because maybe an agency, well, we don't have a strategy, but we have policies. The investments would be in the strategic objectives, because if some of those objectives is, let's say like in the United States, we need to get internet to our rural areas. We don't have that. That would be an investment. So this is what I said when I did the driver-based rolling financial forecast of budgeting. You need to fund each of the projects and initiatives. I said the strategy is disconnected from the budget. The strategy is disconnected from the budget. Well, if we basically identify all those investments, those R&D ones, now we are connecting our policy and strategy to the budget. The CFOs have such an important role here. And Lakshman, I'm probably going to get in trouble when I say this. I've said it at every one of my previous 6 webinars. India is really overemphasis on external statutory reporting and not enough on internal management accounting. And they've got to basically shift that imbalance, because it's all about satisfying the agencies. In the United States, we've got the SEC. External statutory reporting is about valuation, but internal management accounting is about creating value. And that's what this talks about, value-based management. Doug used the acronym VBM, value-based management.
Thank you. Thank you. Doug, you have anything to say on this value-based management?
Nothing additional. I don't think that I've not already said so.
How do you see the citizens deriving this value?
I'm sorry, say again, please.
How the citizens or the public from the services given by the government departments, how are they able to get the satisfaction? The citizens of the country.
Sure. A value ultimately is defined by the citizen in the public sector. It's just like the customer defines value in the business world, the citizen defines value in the public sector. Now, I say that generally. There are other stakeholders too that don't always fully map the citizens. So what I'm thinking, for example, is Congress. Anybody in the federal government in the United States, and I'm sure you have the same situation, to understand what their citizens are asking for, but they can't provide anything if they don't get funding from the government. So they've also got to understand the perspective of their government representatives and how they match those two together, because the input and the output ultimately need to link up. So it is a result of a discussion with your various stakeholders who don't always see eye to eye, and try and optimize that balancing so that you can be successful in your mission.
Thank you, Doug.
Lakshman,
Sorry, yeah.
I want to ask Doug a question, and we're going to blindside him here. But Doug, because we're near the end, what major lessons did you learn? Because Doug was the Chief Financial Officer of the Department of Education under the Trump administration and the CFO of the Department of Labor under the Clinton administration. Doug had thousands of employees in the organizations that you really had a job for. What were the lessons you learned in working in your federal executive roles, Doug?
You are indeed catching me off guard there, Gary. So I'm not sure. I will probably say that in my experience in the U.S. federal government, there are many employees who truly are there because they want to serve the public. And I'm sure that's no different in your cases. That having been said, they also have been brought up with very traditional management approaches, and trying to integrate these new concepts, I would suggest, such as value-based management, is just as much a challenge in the federal government as it is in the private sector. So while there are many obvious differences, there are also sometimes not so much appreciated similarities.
Thank you.
Thank you.
Thank you. I think the time is up now. So I was trying to go for another round, but I think the time is up. So now, may I now invite our Vice President, Mr. Hennaik Bandara, to give the vote of thanks.
Thank you, Professor. Ladies and gentlemen, on behalf of CMA, I am glad to propose this vote of thanks after another successful webinar conducted by Mr. Gary. As mentioned by our president, Gary is not a stranger to CMA. He has helped CMA in the past in numerous ways in conducting CBD programs. In fact, Mr. Gary mentioned that this is the 7th program that he is participating rather conducting. So we are happy to see you again in the future program as well. Mr. Gary being an author of numerous books and articles in the field of cost management accounting, he has made a valuable contribution to the advancement of cost and management accounting techniques in the private and public sector. With that note, I would like to thank Mr. Gary for his insightful presentation and sharing his experiences to educate us on value-based management for public sector. I'm confident that the guidance provided by him will assist all of you to enhance your knowledge and skills. Let me also thank Mr. Douglas Webster for your participation and sharing your valuable experiences. I also would like to thank Professor Dayananda Ambalangodage, Mr. Jayasekara, Mr. Ruchira Pereira for their valuable contribution and sharing experiences. Let me also thank our President, Professor Lakshmana Vatavala, for his guidance and organizing this webinar under the CPD programs to improve the skills of our members and all other participants. Finally, I would like to thank all our members and others for your participation in the CMA team for the support extended to conduct a timely, important webinar. Thank you all. Take care. Stay safe. Good night to all of you.
Thank you very much. Thank you. I think it is a very historic occasion because we are having the co-authors of the value-based management. I think this is a very rare occasion. I must thank Gary Cookings for inviting his co-author, Douglas Webster. I think we are very honored by your presence today. And definitely your message would be really maybe conveyed to the governmental authorities, and I'm sure that they will prepare themselves to provide value to the society and the citizens. Thank you very much, and wish you all the very best.
Our privilege.
Thank you.
Thank
very
you.
much all.
Thank you all.
Thank you. Thank you. All the best.
Thank you,
Right.
Gary.
Thank you all. Good night.
Good night.
Right.
Thank you,
Thanks.
Doctor.
Thank you.